Good afternoon and welcome to another VSA Capital Technology and Transitional Energy podcast with myself, Phil Smith, analyst, and this week my normal partner on the podcast, Andrew Monk, is away on business. Well done, Andrew. And here with me is David Scriven, our sales team. David, welcome to the podcast.
Thank you very much, Phil. Yes, and our dear leader is managing to navigate the storms in North America. I think managed, getting around and about, which is very impressive. But I think I'd be rather here rather than facing a storm. However, let's focus on markets. And as you know, I like to have a look at the US. And starting off with the Philly Semiconductor Index, the SOX, it's just off its high. Now, of course, the big news and the big focus for investors is people looking at Nvidia. Now, the shares were up about 1.5% in extended trading after the chipmaker forecast sales in Q1 of 76.4 billion to 79.6 billion, which beats the street's estimates, but no guidance was given for China. Now, in the fourth quarter, results, data center revenue was 62.3 bill. That's up 75% year over year versus estimate of 65.9. And compute revenue was 51.3 and was up 58% year over year versus an estimate of 51.6. Now, free cash flow was 34.9 billion. Jensen Huang made a number of quotes, of which were computing demand growing exponentially, customers racing to invest in AI compute, and enterprise adoption of agents is skyrocketing. So the results, to me, point to demand not letting up, countering a growing investor concern of the exact opposite. Now, the news didn't ignite the NASDAQ futures, and maybe a little bit of that was to do with general trade uncertainty and geopolitical tensions playing their part. But Nvidia's off about $7 when I came off looking at Bloomberg to join the podcast. Now, in hardware and networking, what's really caught my eye is Ciena. It's a real eye catcher as it reaches $353 versus $82 a year ago. Now, Ciena is the market leader in optical systems and stands to benefit from telecom and the data center interconnect market. This market is expected to grow 20% CAGR from 4 bill to 10 bill by 2030. Key customers for them are AT&T, Amazon, Google, Meta, and Microsoft, and that's client list you probably die for.
Yeah, absolutely, David. Yes, you are right there.
And in battery value chain and in the clean tech ETF, both of those ETFs are making 5-year highs. And just to sort of focus on any one particular name, in the battery value chain, GE Verona, which manufactures electrical power systems, is making all-time highs, 5-year highs, and likewise Sumitomo Electric, which electrical equipment, is doing that as well. And I just noticed that Tim Cook, CEO of Apple, posted to X a big week ahead. It all starts Monday, so I prime you for that.
Wow, well, let's see what that means.
We will indeed.
Yeah.
And then back to something we talked about quite a bit last time we did the podcast together was software. And I was looking at that IGV ETF, which is flirting with the low end of a channel. Now, to me, the battleground is sentiment. It's the AI scare trade or valuation. And in terms of valuation, the S&P 500 software index is trading at less than 21 times EPS. This is the lowest level in 3 years and versus a 5-year average of 29 times. So the real question is, will it break or hold that technical support? And just to be honest, right now, I'd stay on the sidelines to see how it plays out from a technical point of view. But in specific software names and some results that have come out recently, Salesforce gave a fourth quarter beat but lukewarm outlook. So the stock was taken down after hours. Snowflake disappointed investors by giving an outlook in line with estimates, and the stock retreated, but it's actually now up 6% as analysts seem to be homing in on RPO, which is remaining performance obligations, which is up 42% year over year. And I guess it's implying that customers of all sizes view Snowflake as a long-term strategic vendor. And I know you have some thoughts on software. Go.
Yeah, I do. I mean, Monday was a bit of a rough day on the markets for the software players, but also for the PE houses. Apparently, I mean, I was reading that Apollo, Blackstone, KKR, the large PE houses saw their shares soften on Monday, and this is because they've been big investors in pure play enterprise software companies, and the worries about the threat of AI. Now, software is a big piece of investment. PitchBook reported that 18% of deal flow in 2025 was in software. This was from an FT article on the 24th of Feb. And also, Monday saw enterprise stalwart like people like Workday, CrowdStrike, Salesforce, David, as you just pointed out, and Oracle were all down on Monday. But the biggest fall of all came from one of the best, longest established companies of all, and that was IBM, which fell by 13% on Monday. And the reason for this is because AI startup Anthropic said that the Claude Code tool could be used to modernize legacy programming language. This is COBOL that is used on IBM systems, IBM mainframes. This is across banking, insurance, and government systems. And they also pointed out Anthropic that COBOL handles 95% of ATM transactions. So we will see. I mean, COBOL's quite a specific area. They're all specialist consultants that work on COBOL. So let's see what Claude Code tool can actually bring to that. But I don't know. You just think with the AI tools that so much software is designed around specific applications. And that, as we talked about, that staff in organizations working on those applications, there's so many people are trained up with all these very specific software systems. So, any significant change from AI, I think, is going to be gradual, because it's not just about tech change, it's about whole organizational change as well, about working with these tools. So we shall see, but certainly you can see how nervous the markets are on some of these share price performances right now.
Yeah, we've become a little bit fixated by a scare trade, aren't we? Scare.
Yeah, I think so, but it's time will tell. But does that help investors? No, it doesn't, because we kind of want to know and plan investment, in advance. But let's see what happens, how results come through, and see if there is a real impact ahead. But quite clearly, AI is showing that it can do some of the things that existing software already can, and potentially replace it. Let's see, an ongoing one for this podcast, methinks.
Yeah, keep that eye on the sort of technical trend of the ETFs and everything, because at least it might help you in your timing a little bit. Because if you start testing the channel and then it holds it, then it might give you a clue as to timing.
Yes, absolutely. And with the ETFs, of course, look at what's in them. The mix in the ETFs and what it's exposed to in terms of technology. Right, moving on to David. Thanks ever so much for that view of the overall view on the markets in the US. Just moving on closer to home and to the UK. I mean, one of our larger technology and engineering companies has reported this week, and that is Rolls-Royce Holdings. So Rolls-Royce, all about advanced engineering technology for aerospace, defense, and power engineering. They reported, this is full year revenues of just 20 billion pounds, up from 17.9 billion, beating analyst consensus, and 2025 pre-tax profit more than trebled to 6.9 billion from 2.2 billion. Quite a spectacular performance from Rolls-Royce here. And what's particularly of note is their free cash flow, which increased to 3.3 billion from 2.4. Now, looking across the divisions, this is a great stock to get exposure to, obviously civil aerospace and travel, and that's consumer spend, but also defense markets, and through their power systems division, AI, because of course Rolls-Royce is one of the biggest makers of generators that are used in for backup for data centers. The civil aerospace revenues were up by 15% to 10.4 billion, defense up by 4.8 billion, up by 8%, sorry, to 4.8 billion, and the power systems up by 19% to 4.9 billion. And within, each division saw its operating margins increase, which is something that investors were always looking for, because it reflects its increasing profits on the revenue that they're generating. They upgraded their midterm targets as well as the short term. So for 26, we're expecting operating profits between 4 to 4.2 billion and free cash flow of 3.6 to 3.8 billion. But they've also upgraded their midterm targets for seeing an 18 to 20% operating margin and operating profits of 4.9 to 5.2 billion. Particular areas of interest here, especially for me, is obviously defense. They're expecting the business to grow 20% compound, but also for their power systems, where they're expecting very high double-digit growth. So it's all going extremely well for Rolls-Royce, the turnaround of the business there, and to see such high cash generation. With that cash generation and balance sheet, they've also announced a 7 to 9 billion share buyback for 26 to 28. So all going extremely well for Rolls-Royce. Surprise, share price has doubled in the last 12 months. So all your lucky holders of Rolls-Royce out there will be doing very well. Right, moving on within Advanced Engineering Technology, into a smaller company. This was our pick of the year this year, actually. This is Avingtrans, ticker is AVG. Market cap £187 million. Shares are up by 55% over the last 12 months. Now, Avingtrans reported the revenues for the first half were flat at £78 million, just under £79 million previously. This was in line, quote, with management expectations. But particular interest here for me was the adjusted operating profits were up by 27% to £5.7 million. And they have very strong operating cash flow, up to £7.6 million from 4.9. So a real sharp increase in cash flow there. Debt, the reported, is unchanged at £12 million, £12.3 million. And this is despite ongoing investment in its medical imaging business, but also nuclear technology. Now, let's just get on to those businesses. The Advanced Engineering Systems business has a specialist pumps division in particular that supplies power stations, including nuclear power stations. They won new contracts in South Korea. They have an HVAC business called Ormandy, and this is heating, ventilation, and air conditioning. There we go. They had a strong first half and benefiting from data center infrastructure. Of course, data centers need lots of cooling. That's going well. And Metalcraft saw ramp up of what they call 3M3 box productions for nuclear waste at Sellafield. So some nice exposure there across nuclear power, AI, nuclear waste processing. Now, the medical, industrial, and imaging division, this is smaller. This is one that involves highly specialized X-ray technology, particularly for the medical markets. It saw revenue increase by 33% to £2.9 million, and their losses reduced to £0.8 million. Now, one of the was I think a bit of a drag on share price, but this division has been absorbing cash as it's been investing in R&D, and now it's seeing its losses reduce. Also, good news here, it appointed a new divisional head, Stuart Gall, as the CEO. He joined the business in January, and Avingtrans say they're confident about meeting market expectations for full year 26.
Good call.
There we are. So there we are. Not one that we cover or corporate client, but nonetheless, we look at annual recommendations, one you should look at. Traxys, TRCS, is the ticker, £111 million market cap. And this is transport management software and technologies for rail and the wider transport industries. They have said it's expected to report results in line with expectations for the first half of the financial year. It's signed a new multi-year contract for deployment of its train dispatch software. This is in North America. Now, Traxys has been trying to build up its, it is building up its business in North America. And so this is quite important for it. It's gaining momentum there. This is for what's called short line freight railroad. So it's not passenger railroad, it's freight railroad for dispatching trains, I would think. And it said that this builds on a prior contract with US commuter rail operator in the States as well. So they're expecting £39 million of revenue for the first half, up by 7%, and adjusted earnings, quickly turning my page, of £5 million, up by 32%. So gaining momentum, and the shares are finally bouncing back as a result. So there you go. Get the results through, and shares do respond. And they certainly should do, theoretically, David, shouldn't they? One would hope. And the last one for me for this week, we've been a little bit thin on UK news, was yet another takeover approach for a UK quoted company. This time it's Augmentum Fintech, ticker is AUGM. This is a fintech fund manager. Augmentum has 27 holdings of fintech companies, including Zopa Bank, Iwaka, and Gemini. The offer, the bidders come in from Frontier Bidco, which is a vehicle indirectly wholly controlled by Verdane Fund Managers, a Stockholm-based firm. According to Augmentum, they specialise in European tech buyouts, and the all-cash deal values Augmentum at 111p per share, or 185.7 million market cap. So 27% higher than the closing price on Tuesday of this week. And I was just looking at Augmentum's results, actually, and their interims to September, they reported a NAV per share before performance fees of 159p per share. And the share price at the time was 87.8p. So a significant discount to its NAV, and they had cash reserves at the time of £22.4 million. So kind of not surprising. It has attracted a bid, actually, and the board have, they have decided to. It looks like they've decided to recommend that offer.
A few other situations like that, aren't there, that are being vulnerable to being picked off because of discounts to NAV?
Yes, and we obviously seen over the last 2 years, unfortunately, a very good number of approaches to companies on the UK market because of overall valuation disconnect. But what's been very interesting to see is as the US markets have been perceived in some quarters as being overvalued, more money has come into the UK markets and the European markets, and of course that's seen a good performance of the, really strong performance of the FTSE last year.
Yeah, and we've seen some relatively better performance by European tech names versus the US.
Yes,
relatively.
Yeah, that's right, relatively, and from European funds.
Yeah.
Right. So on that note, that more or less completes things for this week's VSA Capital Technology Transitional podcast. I mean, as always, as Andrew always says, if you do have any ideas about companies you'd like us to talk about, anything you think that we've missed, then please don't hesitate to get in touch with us. And David, thank you so much for joining the podcast with us this week.
A pleasure. Thank you very much.
And we'll have the podcast again next week. Thank you.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.